Let's get started talking about stochastics, one of the world's leading technical indicators. Now, in tonight's class, I'm going to use the term security, but I might say Facebook or Google or the euro. I'm still referring to all tradable instruments. I'm not really referring to one particular instrument, but it gets very, very boring just saying security, security, security over and over again. Also, I'm going to intermix the terms investing and trading. Since we're all here learning stochastics, we're all going to be mostly short-term traders, and most investors don't use technical analysis. Okay? But we know the difference. Trading is a much shorter term position, while investing is a much longer term position. Now, the one thing everybody asks me, whether I'm giving it a seminar, a webinar, whether I'm doing personal appearances or one-on-one training, they ask me, what should I buy today? What should I sell today? What will the prices be an hour from now? What will they be tomorrow? Do you think gold's going to go up? Do you think Bitcoin's going to fly? Well, would investing be easy if we knew the answers to these seemingly simple questions? Wouldn't it? Well, I don't have a Ouija board. I don't have a crystal ball. And if anybody out there tells you they can tell you where prices are going to be tomorrow or the next day, they're full of BS. Because nobody can predict where price is going to be, because price moves in random fashions. Okay, it's not predictable because it's made up of the human psychology. It's made up of human decisions. Now, we can attempt to find periods when an asset is moving in a non-random fashion and determine whether it's going to continue going up or turn down or continue going down and coming up. These non-random periods are marked by trends. So if you're attending tonight's class with the hopes that technical analysis and stochastics will improve your investing, I have good news for it. It should. So the question is, how does stochastics help time trades? Well, stochastics gives us what we call overbought and oversold conditions. Now, have you ever had an apple fall on your head while sitting under an apple tree? No, me neither. I don't think I've ever sat under an apple tree. But Sir Isaac Newton did, and with that small thud, the universal law of gravitation was born. What goes up must come down. It's true not only for apples, it's true for the financial markets as well. Even though it's not about gravity, what goes up must come down. And there are several chart oscillators that try to identify price turning points so that we can exploit them. One of the most regularly followed trend indicators is stochastics. Now, stochastics falls in a category, let's start with the big category, of technical analysis. Now, a lot of people assume technical analysis, all these complicated mathematical formulas that give us indicators like RSI, stochastics, MACD, Williams percent R, CCI, all of these advanced things. But those are all the category of technical indicators. It's only one sector of technical analysis. So that technical analysis covers everything and anything we basically do on a chart. So whether you're looking at a chart, whether you're reading Japanese candlesticks, whether you're putting moving averages on a chart, whether you're putting trend lines and looking for triangles on a chart, okay, it's all technical analysis. In this field of technical analysis, we come up with technical indicators. And under indicators, we come up with one smaller field called oscillators. And an oscillator does exactly what it sounds like a radio oscillator. It gives us waves. Well, my drawing's not so good, but it gives us waves moving up and down, measuring something. Okay. In the field of oscillators, we have what's called bounded oscillators. A bounded oscillator always comes within a specific range. So no matter how you calculate stochastics, no matter what happens in the market, the stochastics calculation will always come out between 0 and 100. Always. Now, like MACD does the same thing, but it's a positive and a negative number. Okay. Some based on a 50 line. MACD, but they all oscillate between these numbers. Okay. Stochastics will always come out between 0 and 100. It measures the distance between an asset's closing price and the range of highs and lows over a specific period. So as an asset closes near the high of the range, the stochastics oscillator rises. So in other words, if you were looking at gold and gold was 1250, 1250, 1250, 1250, we're looking at a 15-minute chart. We're looking at, say, over a 12-day period, 12 time frame period. As gold, the price of gold moves closer, so its range, say, was between 1225 and 1250. As gold price moves closer to its 1250, the top of its range, so will the stochastics oscillator. Okay. And at some point, it will move higher up. And as the price of gold starts coming to the lower point of its recent trading range, it'll move down towards 0. So supporters of stochastics oscillator like it because it's easy to remember the defined areas between 0 and 100. So let's go over to a live chart and take a look at this so you understand what we're talking about. Let me get this chart up on your screen. Okay, so let's go over to my teaching chart. Here we're looking at the Euro US dollar. And we're looking at the Euro US dollar on a 30-minute chart. Now I've dropped the stochastics on the bottom. You simply go up to your indicator selector and click on stochastics, and it will drop it on the bottom of your chart. Stochastics appears underneath price. Now, if you notice here, we have a 100 range and we have a 0 range. In between here, we have an 80 boundary and a 20 boundary. We could almost call this no man's zone. Between the 80 and the 20 doesn't tell us that much. When the stochastics oscillator breaks above the 80, it's telling us that that asset is overbought. When it falls below 20, it's telling us that asset is oversold. Now, overbought and oversold markets can remain overbought and oversold. Now, the standard formula for stochastics is based on inputs of a smoothing period of 3, a D line of 3, and a K line of 14. Okay. Now the D line and the K line are down below. This is the blue and the red line. Okay. Now, yes, I know you have no idea what D and K lines are. So we're going to go back over and talk about what the calculations are and how this is achieved and what they try to tell you. So let's go back to my PowerPoint, but I wanted you to see where stochastics was and where they were placed on your chart. So I've got a little short presentation prepared for you. I'm going to play that for you. That's going to show you these calculations. We'll talk about them again as soon as this is over.
Here's a badly drawn example of what it might look like. You can see why I'm not an artist. So we have the price here. This is what the price is doing. This is the market, whatever market it is. Then we have the percentage D line. Let's say this is a 10-day stochastic. So that will be our percentage D line with a value of 3. And then we have the percentage DN line, which is just a smoothed out version of that red line there. So using it simplistically, we have our overbought and oversold areas that we're maybe used to from things like the RSI. So that might be 70% and 30%. When the market goes below 30%, it's said to be oversold. We're expecting a bounce, but the signal comes from the percentage D line crossing through that DN line. So hopefully you can see that. We'll look at it in a real market in a minute. The sell signal comes when we go to the other extreme. We go above the 70% line here, and the stochastics hook lower. That would be our sell signal. And we also have this idea of divergence, which we've talked about before, where, for example, here the market pushes to a low, but our stochastics start trending up. That's known as bullish divergence, and can be a suggestion that maybe the weakness is running out of steam. And up here we have the opposite of that, where the market pushes out to fresh highs, but our stochastics are falling. That's known as bearish divergence, so it can be a suggestion that maybe the market, the rally, is starting to lose some momentum and it could be time to go short. So a couple of ways to use it. The simple crossover approach here, and also spotting these divergences where the market does one thing, but our stochastics are doing something else. Okay.
Okay, so the simple rule of stochastics. Now, in the little presentation, we talked 70-30. Now, see the range over here, the 80-20. This is the range that George Lane, George Lane, who developed stochastics, came up with it. Now, 80-20 works very, very well and is what the standard is. You can adjust these levels to a 70-30. Now, 70-30 is used more in RSI than it is stochastics, but we can change our percent levels depending on the frequency you want and how sensitive you want your indicator and how many false signals you get. When you move it to 70-30 and you're using those for overbought and oversold zones, you would then get more input above the overbought. You'd be overbought more often at 70 and oversold at 30. And so therefore you would get more false signals. So I always stick with the original developer's strategy because that has been tested in the market for years, and that's what's made this indicator so successful, is because it works so well. But you can adjust it, and there's lots of strategies out there and lots of gurus who use a 70-30. You'll hear somebody pushing a 75-25, but 80-20 is the standard. Same thing with your setups for the KD lines, percent K and percent D. There are two schools of thought out there. There's a 10-day, the 10-period K line, and then there's the 14-period K line. D is usually constant at 3, and the smoothing is at 3. Okay, so again, I haven't really explained it to you. So let's go back to my PowerPoint and see if we can explain to you what these calculations are and what these lines come from. Okay, so the fast moving line on the chart is shown as the percent K, and the slow moving line is the percent D. A slow stochastic smooths the percent K line using a default 3-period simple moving average. The percent D then reflects a moving average of the percent K. So the percent D line is simply a 3-period moving average of the previous line, or the K line. Okay, the K line crossed above the percent D, giving an indication of support. Okay, let's so let's break down this indicator. You'll never have to do this by hand, but the percent K is equal to 100 times the latest close minus the lowest close, or the lowest closes or the lows, I'm sorry, the lows for the last 14 periods. Then it's divided by the high of the 14 periods minus the low of the 14 periods. So in other words, C is the most recent closing period. L14 is the low of the 14 previous trading sessions. And H14 is the highest price traded during that 14 sessions. So if we're using a percent K as a 14, and we're using a 15-minute chart, we will go back 14 candles, say, take the lowest price that that candle had hit in that last 14 periods. We'd also find the highest price that candle had hit in the last 14 periods. So then we would take the current close of the candle minus the lowest close of the last 14 periods, divide that by the highest point it had reached in the 14 periods or 14 candles, minus the lowest it played in the 14 candles. And that would give us our percent K line. We would then take that number and we would take an average of that number over 3 periods, and that would give us our percent D line. Okay, so I'm going to make these lines a little bit bolder so you can see them a little better. Okay, so the dark blue, well, it's a bright blue line on the bottom chart, is the percent K. And we're going to use this as a 14 period. And we're using the percent D as a 3 period. So what we've just done is we've taken, let's go back and count candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So we're going to take the close of this candle, whatever it was, we take that close minus the lowest low that that candle had hit, which is right there in the 14 periods. We would divide that by the highest high, which would have been this price up here, minus this same low. And we would multiply that times 100 to get our percent. Okay. And that gives us our calculation for the blue line, the percent K line. Then we would take this and take 3 of these going back, add them together, divide by 3, and plot them on the chart. That would give us our red line, which is just simply a moving average of the blue line. When the blue line crosses over top of the red line, that would give us a buy signal. When it crosses below, that would give us a sell signal, but only when it is in the overbought or oversold territories. If it crosses in the middle, it's not giving us a buy or sell signal. So in other words, here we got market was oversold. We got the crossover, but look what happened. The market continued downward. Here we got oversold and we got a crossover. So here it's generating a buy signal telling us to buy upward. Here, crossed over, moved into overbought territory. That's telling us the market should start to fall, and it did. One of the biggest problems when a market is trading sideways like this, you can't rely on the overbought and oversold scenario. But that is how we calculate the percent K and percent D. Again, you'll never ever have to do it because all the indicators automatically dropped in. But you should understand what the adjusting of the 20 and the 80 boundaries are to use the 70-30, and the adjusting the period in which you are looking at on your chart for the percent K line, which is the two standards. The standard from the development is 14, and because we're in CFD markets that are a little bit more faster moving, we can use a 10 period calculation for the percent K. The general theory serving as the foundation for this indicator is that in a market trending upward, prices tend to close near their highs. In a market trending downward, prices tend to close near their lows. The transaction signals created when the percent K crosses through the 3-period moving average known as percent D. The premise of stochastics holds that a stock's closing price or an asset's closing price tends to trade near the high end of the price action. So J.D. Swagger, the CEO of Wizard Trading and author of some of the best books written on technical analysis, used the term normalization or normalize to describe stochastic oscillators that have predetermined boundaries on the high and the low side. An example of such oscillator is the relative strength index RSI, which has a range of 0 to 100 and are set to either 20 and 80 or 30 and 70. Whether you're looking at a sector or an individual issue, it can be very beneficial to use stochastics and RSI in conjunction with each other. Okay, now here's a place that I firmly disagree. Now, even though some wizards out there have said all of these things, for the stock market, if you're investing in stocks, possibly. I don't know. I don't do stock markets and I don't, do that type of indication for investments. The fact is, when we tend in forex and CFD trading, is we would like to use oscillators and indicators that give us other pieces of information, not ones that work in confluence and give us the same information. Because RSI and stochastics should be giving us the exact same information. They're giving us overbought and oversold zones. So why do we need 2 times? Because overbought and oversold can remain overbought for quite some time and oversold can remain quite some time. So I would like something to confirm. I would like a trend indicator as well as a momentum indicator, as well as a overbought and oversold indicator. I don't want to use double the indicators. So I prefer RSI to stochastics. But the markets swear by both. The K line is the fastest and the D line is the slower of the 2 lines. The investor needs to watch as the D line and the price of the issue begin to change and move into either the overbought or the oversold positions. The investor needs to consider selling when the indicator moves above the 80. Conversely, the investor needs to consider buying when an issue moves below the 20. And it's starting to move up with, and here's the word, increased volume. An overbought indicator can remain overbought for quite some time. Because what happens is price moves up and up and up and higher and higher and higher, and the trend still is holding strong. There's a good chance that that asset will move into an overbought zone and stay there. Because what it's telling you is, if you're looking at a rocket shooting in the sky, you know sooner or later that rocket's going to lose its momentum and flip back down to earth. But that rocket, as it starts to lose momentum, can still continue up. And if it happens to hit a pocket of warm air, it might carry up for a lot farther. There's no guarantee when it's going to actually tip over and return to earth. So I don't feel that you can use stochastics for a buy and a sell signal. I use them as a confirmation or a prediction, but I don't make my trading decisions based on them. So when your stochastics is a high value, it means that the price closed near the top of the range over a certain time period or a number of price candles. Conversely, a low stochastics value indicates that the momentum to the downside is strong. The main difference between fast and slow stochastics is summed up in one word: sensitivity. The fast stochastics is more sensitive than the slow stochastics to change in price of the underlying asset. However, to really understand this difference, you should first know what the stochastics momentum indicator is all about. Now, there are three versions of stochastics. The fast stochastics is based on George Lane's original formulas for the percent K and the percent D. The percent K in the fast version that appears rather choppy, and the percent D is the 3-period moving average. In fact, Lane used the percent D to generate buy and sell signals on bullish and bearish divergence. Because the percent D of the fast stochastic is used for signals, the slow stochastic oscillator was introduced to reflect this emphasis. The slow stochastic indicator smooths the percent K with a 3-day moving average, a 3-period moving average, which is exactly what the percent D of the fast stochastics does. Notice that when percent K in the slow stochastics oscillator equals percent D of the fast stochastics. This is the smoothing indicator. Okay, so we're using if you're using a fast 3 and a slow 3, okay, they take off the smoothing period. We use on the whole a 14.33, which has all got it built in. But if you take off this let's go back to the chart and I'll show you. If you take off the second 3, which is a smoothing indicator, that gives you a faster stochastics. So in other words, see where we have the smoothing? Okay, if we change that to 0, that actually in essence creates a faster stochastics. You add the 3 back in, you get a slower stochastics because it's smoothing out the movement. It's using a different moving average. Okay, but again, for our type of trading, we pretty much stay away from it. We use the standard 14.33 or a 10.33. As a bounded oscillator, the stochastic oscillator makes it easy to identify overbought and oversold levels. The oscillator ranges from 0 to 100, no matter how fast the security advances or declines. So I've got a little presentation prepared for you that will show you how to use this in your live trading and how to use it to make trading decisions. So let me pop that up on the screen, and then we'll talk a little bit more about using stochastics. Now you might have to turn up your volume a little to get this properly.
In an uptrend or a downtrend first. In this example, price is making higher highs and higher lows, illustrating an uptrend. Once this has been established, one must define the direction to trade in. In this case, we will look only at taking longs or a buy in the market. Firstly, we need to pay attention to the oversold area here, at this point here. Once the stochastic enters this zone, this will govern the entry point to enter a buy order once the two lines have crossed upwards. The K period has crossed the D period line at this point. It must be stated that an entry is confirmed only when this occurs in the zone which is the oversold area, not above the area. It must be clearly in the oversold status to warrant an entry. As you can see, a buy order could have occurred at these points right here. Now, at this point here, price is making lower lows and lower highs. Therefore, we start to look for shorts or to sell, no more longs. We need the stochastic to head into the overbought area and wait for the stochastic to hook down and cross over in order to enter a short. From this example, this is the only opportunity here for a short, as we know price is going down, and for the first time, the stochastic is in the overbought area. Apart from using price action alone to define direction when trading with a stochastic, one may elect to add a filter into the mix to ensure a more detailed strategy. Adding the Trading at MA band indicator as a trade filter could help eliminate a lot of bad entries. It's a conservative approach by adding moving averages into the equation. For instance, once price is trading above the band, as you can see at this point here, we only look for longs or to buy. As price is trading below the band, we look for shorts or to sell. What we are doing is defining the trend by saying that the MA band is the filter. Above it, we buy, and below it, we sell. As you can see at these points here, price has been trading above the band, which warrants a search for a long entry. At this point, we have to look at the stochastic to make sure it's in the oversold area as it is here. Then we wait for the stochastic to hook up and cross over, then a buy order can be executed. Typically, the close of the candle or the bar should be above the MA band. However, at times it works just as well while the candle or bar closes in the band. Once price drops below the band, looking for a long is invalidated. Even though the stochastic has entered the oversold zone here, the band filter is indicating a potential change in the trend to the downside.
So, as with any other trading concept or tool, you should not use stochastics indicator by itself. To receive meaningful signals and improve the quality of your trades, you can combine stochastics indicators with three tools. Moving averages, as you just saw in our presentation. Moving averages can be a great addition here as they act as filters for your signals. Always trade in the direction of your moving average and above the band. And as long as price is above the moving average, only look for longs. So if the stochastics is giving you a sell signal or an overbought signal, it shouldn't be executed. So you should always be trading. If it's a sell, you should be trading below the bands. If it's a buy, you should be trading above the moving averages. Then we can use price formation. As breakouts or reversal traders, you should look for wedges, triangles, and rectangles. When price breaks such a formation with an accelerating stochastic, it can be a potential signal for a successful breakout. And then lastly, adding on trend lines. Especially stochastics divergence or stochastics reversals can be traded nicely with trend lines. You need to find an established trend with a valid trend line and then wait for price to break it with the confirmation of your stochastics. So just like you see here on the chart. Now you might not need the stochastics indicator when you are able to read the momentum of your charts by looking at candles. But if the stochastics is the tool of your choice, it certainly doesn't not hurt to have it in your charts. More importantly, it's for you to realize how little you might know about tools you are using in your trading. Additionally, there's a lot of wrong knowledge being shared among traders, and even widely used tools such as the stochastics indicator is often misinterpreted by a majority of traders. Do not blindly believe what other people tell you. Do your own research, know your own, or build your own trading knowledge. So traders will often cite when a stock makes a higher high, but the stochastics does not exceed its previous swing high, that the trend is in jeopardy. This could be the furthest from the truth. The slow stochastic indicator ranges from 0 to 100. So as the stock rallies, how can that rally stochastic continue to make higher if it's already hit 98.95. Unlike price, which has no boundary, stochastics is an oscillator, so it will never truly mimic a security's price. All that matters is that the stochastics continues in the direction of the primary trend. Traders will often exit long trades when the slow stochastic crosses over 80 or will buy at under the 20. The problem with this trading methodology is that if an asset is over 80, it should not be looked upon as overbought, but rather as trending strongly. So remember, trading is not that simple. It's not black and white, just saying I'm going to do this above 80 and do this below 70, okay, or below 20. You want to look for the crossovers, but you want to see which direction and ultimately do an analysis of where the stochastics has been. You also need to be familiar with stochastics on each of your assets, because sometimes certain assets, especially like Bitcoin, can stay well in that overbought zone or is always hitting 85 and 90. So for instance, if you see an asset that's always hitting 85 and 90, but not changing direction, you might want to change your boundary to an 85 or 90. You need to know where to react. So remember, trading isn't that simple. So while momentum oscillators are best suited for trading ranges, they can also be used with securities that trend, providing the trend is on a zigzag format. Pullbacks are part of uptrends that zigzag higher. Bounces are part of downtrends that zigzag lower. In this regard, the stochastics oscillator can be used to identify opportunities in harmony with the bigger trend. The indicator can also be used to identify turns near support or resistance. Should a security trade near support with an overbought stochastics, look for a break above 20 to signal an uptrend and a successful support test. Conversely, when a security trades near resistance with an overbought stochastics oscillator, look for the break below 80 to signal a downturn and a resistance failure. Now, the settings of the stochastics oscillator depend on personal preferences, trading style, and time frames. A shorter look-back period will produce a choppier oscillator with many overbought and oversold zones, like moving from the 14 to the 10. A longer look-back period will provide a smoother oscillator with fewer overbought and oversold indicators. But like all technical indicators, it's important to use the stochastics oscillator in conjunction with other technical analysis tools. Volume, support and resistance, and breakouts can be used to confirm or refute signals produced by stochastics. So thank you very much for joining us tonight. If you want to learn more about stochastics, go to www.ubcfx.com and go to their education center. Now, before you go, if you notice on your screen, I put together two handouts for you. I've tried to give you all the information on stochastics in easy format with charts and everything else in that. On your screen, you see where it says under handouts, stochastics guide, handout final. Just click the download button, download it to whatever device you're using because you can't get it except in the live class. And I've tried to give you every type of trading scenario possible there. I've also given you the technical indicators guide from investing.com. And that's an excellent research and resource guide for all the major technical indicators or technical indicators and oscillators in the marketplace. Just click the download button. There's no registration, there's no fee, there's no nothing. Download them to the device you're using. Use them as a resource guide in the future, and they're on us. So please click on those download buttons before I close out the webinar because you won't be able to get them at a later time. So thank you very much for joining us, and thank you for supporting UBCFX and investing.com. Have a great trading night. Bye now.